Welcome to our deep dive into Public Storage's first quarter 2025 earnings call.
Yeah, we've gone through the call, pulled out the key bits.
Exactly. We want to give you a clear, efficient understanding of their performance and what's happening in the self-storage world right now.
Get you the important insights.
Okay, let's get straight to it. So, Public Storage basically met their own expectations in Q1.
Yeah, they framed it as stabilization, things firming up across the portfolio.
Right. And what caught my eye was the move-in volume, up over 2%.
That's right. Driven by better website traffic and getting those visitors to convert into customers.
So their online strategy seems to be paying off then.
Seems like it. It's a key insight, really, that digital customer acquisition is working.
And another positive sign, the occupancy gap compared to last year.
Oh, yeah, that narrowed quite a bit, significantly.
It went from, an 80 basis point drop at the end of 24?
Down to just 30 basis points by the end of March. So pressure's easing.
It's just demand is picking up, doesn't it?
Definitely a healthier demand environment than late last year. That's a key sign of stabilization.
And the big one, same-store revenue. It actually turned positive.
After, more than 2 years of deceleration? Yeah, that's a significant milestone.
Shows their pricing and occupancy strategies might be, gaining traction.
I think so. A real shift in momentum there.
Now, what about the non-same-store side? Those newer properties?
Yes. They're really hitting their stride. Revenue growth there accelerated to nearly 11%.
11%. And that's like 520 properties?
Yeah, about 21% of their whole portfolio. So that growth is, it's hard to ignore.
A big future driver, potentially.
Absolutely. It underscores a key part of their strategy, leveraging those newer assets.
And all this fed into their core FFO per share, funds from operations.
Right, the key REIT metric. It grew over 2% for the quarter.
Which, importantly, was a big jump from the previous quarter, right?
A substantial jump, 200 basis points sequentially. It shows the impact of revenue growth and their operational efficiencies.
Paints a picture of improving financial health then.
Clearly.
So what's behind all this? What are they saying is driving this performance?
Well, they keep coming back to a few core things. Their high-quality portfolio.
Location, basically.
Pretty much. Plus their innovative platform tech, operations, and just general company-wide advantages.
Right. They specifically mentioned their revenue management system.
Yeah, they claim it consistently gets top revenues per square foot in their markets.
Which sounds like a pretty significant edge in maximizing profit.
It really does. If true, it points to a very sophisticated system, dynamically adjusting prices.
And they're pushing hard on digital transformation, too.
85% of customer interactions are now digital. That's huge.
Beyond just convenience, though, they're using AI for staffing.
Yeah, streamlining operations, making it more efficient, using data to figure out staffing needs.
That's pretty forward-thinking. Does it show up in the numbers?
Mm-hmm. Apparently so. They report same-store operating margins are, quote, meaningfully higher than the industry average.
So that digital efficiency translates directly to the bottom line.
Seems that way. A tangible outcome of the tech and the operating model changes.
Okay, so beyond the existing stores, they're looking at growth elsewhere too, right?
Oh, yeah. Actively pursuing it. Acquisitions, new development, redeveloping older sites.
And international. So something about Australia and New Zealand.
Exactly. The proposed Abacus Storage King deal, building on what they learned with SureGuard in Europe.
So diversifying their growth avenues.
Makes sense. Capitalize on different opportunities, expand their reach.
Has the acquisition activity picked up then?
Definitely. As of May 1st, they had $184 million either acquired or under contract.
Wow. Compared to what? $35 million same time last year?
Big difference. Shows a more aggressive, opportunistic approach. They have the balance sheet to do it.
Which we'll get to. And those non-same-store properties, they expect more from them.
Yeah, they're projecting an additional $80 million in NOI net operating income once those stabilize.
So 2026 and beyond, that's a nice chunk of future income baked in.
Significant embedded growth, absolutely, as those assets mature.
And underpinning all this activity is what they call the industry's best balance sheet.
Which is critical, right? It gives them stability, flexibility, the firepower for acquisitions and development.
Probably better borrowing terms too, I imagine.
Often does. It's a key competitive advantage.
Okay, let's shift gears a bit. The broader self-storage industry, how do they see it?
Well, they emphasize the basics. It's needs-based, resilient.
Driven by life events, moving, downsizing, divorce, unfortunately.
All those transitions, that creates consistent demand, less tied to just discretionary spending.
They even suggested that an evolving economy can create new customers.
Yeah, shifting demand drivers. Maybe more small businesses needing flexible space, for instance. Adaptability is key.
And it's relatively affordable, they argue.
Compared to other space options, yeah, that helps its resilience, makes it cost-effective.
Now, they talked about the market normalizing over the past few years. What does that mean exactly?
Basically, those really high pandemic-era moving rents have come down significantly.
So new customers are getting better deals. Rates, like back in 2013.
That's what they said, which sounds low, but it positions them well. They get people in the door.
And then potentially raise rates later if demand keeps improving.
Exactly. Build a solid base now for future revenue growth.
Are they seeing signs of that improving demand?
It seems so. Industry-wide search trends are up year over year, bouncing off the lows of 2024.
And public storage is seeing that too. And web visits, calls.
Similar positive trends, yeah. Suggests a recovering market, renewed interest.
Interesting point they made about why people need storage now.
Oh, right. Less driven by new home sales specifically,
Because the housing market is slower.
but more driven by people just running out of space at home. The stuffication crisis, as you called it.
Oh. Well, it highlights how the need adapts, I guess.
It does. More about decluttering space management.
But looking ahead for 2025, they're not banking on a huge traditional peak leasing season.
No, it seems like a cautious outlook there, mainly because of that subdued housing market activity.
Okay, let's dig into the financials a bit more specifically. Same-store revenues turned positive.
Driven by higher rental rates, they said, after 3 down quarters.
So pricing power seems to be returning. That's key.
Yeah, a very key indicator, yes.
And expenses, how did they manage those?
Really well in Q1. Only 30 basis points of growth. They credit operating model changes, lower ad spend.
But they put a caveat on that, didn't they?
Yeah, some Q1 benefits like easier payroll comparisons might not stick around all year.
So expect expense growth to maybe tick up a bit later.
That seems to be the implication. Expect some normalization.
Okay, FFO per share again. $4.12, up 2.2% year over year.
And they stressed that was a strong acceleration from the previous quarter's growth.
Right. But despite that strong start, their full year guidance is unchanged.
That's right. Which is interesting.
Makes you wonder, are they being conservative? Or are there headwinds they're factoring in?
Could be either or both. Maybe caution given market uncertainty, or maybe they anticipate specific challenges.
Like the fire-related issues in Los Angeles.
That's definitely one major factor. They quantified that impact.
A 100 basis point negative hit to same-store revenue growth for the full year.
Yeah, and worse in the back half of the year, potentially bleeding into early 2026.
And that affects about 10% of their same-store portfolio. That's significant.
It is a notable headwind, especially for revenue later this year.
Okay, switching to development, they're still building.
Oh, yes. Delivered $144 million worth in Q1. And the pipeline is pretty robust.
Around $650 million over the next 2 years.
That's the number. Even as the broader industry slows down development, they're pushing ahead.
Shows confidence, I suppose.
Yeah.
Or maybe less competition for sites.
Probably a bit of both. Highlights their ability to find and execute projects, a big future growth driver.
And acquisitions. We touched on that, $184 million under contract or done in Q1.
Yeah, ramping up activity there too. Proactive expansion.
And they sounded pretty upbeat about that Australia-New Zealand deal, Abacus Storage King.
Very optimistic. Clearly a big strategic move for their international growth plans.
They mentioned retained cash flow is expected to jump too, by 50%.
To around $600 million for 2025. That's a lot of cash.
And they plan to reinvest that, primarily in
Development and acquisitions. That's where they see the best risk-adjusted returns.
fuels the growth engine.
Exactly. Provides significant capital for those initiatives.
Now, I found this interesting. They're not lowering their return expectations on development projects, even though move-in rents are low right now.
Right, rents like 2013 levels, but they feel there's less competition for development.
So they can still find attractive deals across different markets.
That seems to be their rationale, confidence in their market selection and the long-term potential despite current rent levels.
Okay, let's touch on operational efficiencies. The staffing model.
Their dynamic staffing model, yeah.
Yeah.
Using data to match labor hours to customer demand.
And it led to a 12% drop in labor hours in Q1.
That's what they reported. They think it's pretty unique and has more room to improve.
Shows a real focus on data analytics for cost management.
Definitely. And it ties into the broader digital success story.
85% digital interactions, better efficiency, better customer experience.
It all connects. Streamline operations, happier customers, hopefully.
And solar power investments. Paying off.
Starting to. Contributing to lower electric utility usage, smart long-term cost saving, and good for the environment too. A practical sustainability effort.
Thinking about investors now, the private market for storage has been a bit quiet.
Yeah, transaction volumes were light in 2024 and early 25, though institutions are still interested in the sector.
Maybe just a period of price discovery or caution?
Could be. Broader economic uncertainties might be playing a role.
They also noted their move-in rates fluctuate quite a bit.
By market, by month. It's part of their revenue management balancing rate and volume to maximize total revenue.
A dynamic approach. And the ECRI program rate increases for existing customers.
Performing in line with expectations, they said. It's always a balancing act, right? Price sensitivity versus the cost of losing and replacing a tenant.
True. And finally, what about a potential economic downturn? How resilient are they?
Well, they'd watch payment behavior, delinquency, move-outs closely. But they lean on history.
Self-storage has typically held up well.
Because of those diverse, needs-based demand drivers and the flexible month-to-month leases, it gives them some inherent resilience.
Provides a degree of confidence, even if they're monitoring things closely.
Exactly. Proactive monitoring plus sector resilience.
Okay, so wrapping this up,
Yeah.
what's the big takeaway for you? What does this all mean?
Well, it feels like Public Storage is navigating this normalizing market pretty effectively. They're leaning hard on efficiency.
The digital side, the staffing model.
Right. And they're pursuing growth quite strategically, acquisitions, development, international now. Plus, that strong balance sheet gives them options.
Yeah, the call really highlights their proactive approach in a changing environment. They seem confident in the long-term strength of the business.
Despite some near-term headwinds like the LA pricing caps.
So this deep dive gives you a pretty good snapshot of a major player in real estate right now.
Definitely. Lots to think about.
So a final thought for you listening. What do you make of their big push into international markets like Australia? Is that the right move, or does it introduce new risks? Or maybe consider the long-term payoff of these deep investments in digital and AI. Will that create an insurmountable competitive advantage down the line?
Good questions. We encourage you to dig deeper into their financials and keep an eye on those broader industry trends.